Hey there, Brian Bogner, Greg Towner here. It's time for our monthly video, and the title of the video this month is Why We Haven't Recorded a Video in Over a Month. Last month, April and March, we were recording sometimes 2 videos a week just because there was a lot happening, a lot going on, and we were really just trying to stay in front of everything that was changing so quick. Well, it's been a month since we've recorded this, so let's talk a little bit about why we haven't been recording as many of these videos. Let's get started. Take it away, Greg.
Okay, great. Thank you, Brian. Yeah, actually, what's been happening is the market just continues to plow higher. If we look at the purple line here, that's the S&P 500. Last time we spoke, it was kind of temporarily stuck at that orange line, the 50-day moving average. We talked about how the investors were really skeptical of the climb. We were bullish, but in hindsight, we probably weren't even bullish enough because we thought maybe the market could pause a little there. It surged higher. It's at another natural point where it might pause. The 200-day moving average, also the round number of 3,000. But if there's one thing that's been proven here in recent months, the market loves to defy what seems logical. So perhaps it can punch through that resistance point.
I know, as I've been reading a lot, Greg, you know, a lot of analysts out there saying, oh, the market's going to be in a trading range. It's going to 200-day moving average on the top and the 50-day moving average, and we're going to see it kind of just go in a trading range. So, you know, just like you say, though, when everyone starts talking about something, typically the market likes to surprise us and do the opposite.
Yeah, so let's talk about what has actually made this last surge possible in stocks. This chart here is actually just looking at the market return from the lows March 23rd. And what we see is this purple line is actually a high beta index. So the most volatile stocks, they've actually been by a wide margin, the largest upside performers since the market low. So that's, you know, your lower quality companies, your cyclicals, most of them got beat up the worst during the downturn. Much better performers than say the S&P 500 or a low volatility type index. And so we've been trying to look for areas to gain a little bit of exposure to that beta side because we know historically they do tend to perform well off of market lows. What you have to be careful of though is a lot of those companies are best to be rented and not owned. You know, you don't want to necessarily hold them for buy and hold the long term because a lot of them are lower quality. They don't meet the metrics we look for. But we are finding some names that meet that and participating a little bit in the higher beta upside. We think this is a great chart. A lot of data going on here, but let's kind of summarize some of our more important takeaways. This looks at historical big returns, 40-day returns off of market lows. The current return that we're seeing is actually second all time behind only 2009, and we'll get to why that's a good comparison. But if we look at the data off to the far right, what we see is 6 and 12 months later, historically, beyond the return we've already seen, markets tend to perform even better than average after these kind of big surges. So it doesn't mean that we've had this big surge and it's all done. What it means is historically, when you have a big surge like that, it's bullish looking out 6 to 12 months. Of course, obviously you can have corrections in between, but it's a positive sign. And so I mentioned the comparison to 2009. We're seeing a lot of the same comments that we saw back then. We actually wrote a paper about this a couple of years ago, the emotional investor.
Right.
Why, you know, that people can't believe it, that the economy is terrible. How can stocks go up? It's just Fed driven. You know, all these reasons why the market shouldn't be going up, but that's what stocks do. They don't go up when you want them to go up. They go up on their own timetable, looking out ahead.
Yeah. And one thing I do want to point out about this too, Greg, just interesting is, you know, 40 days after the low, right, you typically see your largest gains. I mean, if you look at all these gains here historically and you look a year later, you know, most of these year later are still less than here. So you know, if you talk, even the investor on the other side of the coin that's just thinking like, well, you know, shoot, are we going to see this big move? You know, historically, the good chunk of the move's in, but does that mean we sell or we go? No, I mean, there's still a lot more. I mean, look, I don't know about you, but I'd take a 33% return or a 20% return over a year any day of the week. Okay.
Right.
So there's still a lot more upside. It's just probably not going to be, you know, we had 1 month of this. We're not going to see probably another month of that. You know, there's going to be some volatility, some ups and downs. We need to let the dust settle and things like that. So let's take it into the summary here. Look, the reason why we haven't recorded a video over since in a month, because our message is the same as it was last month. Okay, the stock rally has continued higher despite all the skepticism, all the negative news, all the stuff that's out there. And you've heard us like a broken record tell you, stop watching the news when it comes to market analysis. It's never correct. Okay, we are more encouraged lately because the higher beta, more volatile stocks are really starting to lead this surge now, which is normal. It's textbook of what you like to see off the lows. And then, as we just talked about, forward returns after these moves tend to be above average. So, we've got a lot of things lining up. Now, I don't want to just come at you and say, hey, everything's rosy, everything's great. There are some things that we're looking at. Two things in particular, which I'll mention. I don't have bullet points on here, but I'll mention them anyway. While we're seeing some cyclicals and some things like that in the market do well, one area that's not participated very well have been the banks. And it's a really tough interest rate environment for them, even though they're doing a lot of loans right now. The rates are really low, so that spread's really not there for them that they typically make. So, but you need financials to participate. So again, this is an area we're looking at. Does it always work out that way? No, but that's an area of caution for us. Another one is international is still lagging here. Even today, China's doing some things that's affecting very negative things in Hong Kong right now that's come out today, and there's some things. So international still not really participating like the U.S. is, and we would like to see a little bit more participation on the international side. So it's not that we're coming at you with rose-colored glasses here and saying everything's great, thumbs up, don't have to worry about it. There's still some concerns out there, but the path of least resistance for now seems to be higher. So if you have any questions or thoughts, please give us a call, shoot us an email. You know how to get a hold of us. Thank you so much for listening, and we will talk to you again hopefully next month, maybe sooner, but we'll definitely talk to you here soon.